It is essential to understand the basics of the U.S. income tax system. Knowing how income taxes work will help you make informed decisions when you enter the workforce and ensure that you fulfill your civic responsibilities as a taxpayer. Income taxes are a critical component of the U.S. tax system. They are mandatory contributions that individuals and businesses make to the government based on their earned income. The money collected through income taxes is used to fund various public services such as education, healthcare, infrastructure, and national defense. The United States employs a progressive tax system, which means that as an individual's income increases, they pay a higher percentage of their income in taxes. This system is designed to ensure that those with higher incomes contribute more to the public good, while those with lower incomes have a lighter tax burden. One of the first steps in understanding income taxes is becoming familiar with Form W-4. When you start a new job, your employer will ask you to complete this form, which determines the amount of tax withheld from your paycheck. On Form W-4, you will need to provide information about your allowances. Allowances are claims you make on your W-4 that reduce the amount of tax withheld from your paycheck. The more allowances you claim, the less tax is withheld. The primary factor in determining your allowances is the number of dependents you have. A dependent is typically a child or a relative who relies on you for financial support. By claiming dependents on your W-4, you can reduce your tax withholding to account for the additional expenses associated with supporting them. It is essential to fill out your W-4 accurately to avoid owing a large sum when you file your taxes or receiving a significant refund. While a refund may seem like a bonus, it essentially means that you have been giving the government an interest-free loan throughout the year. Most individuals must file their income tax returns by April 15th of each year, although extensions are available in certain circumstances. There are several methods for filing your taxes, including paper forms, online tax preparation software, and professional tax services. One of the most important aspects of the U.S. income tax system is deductions. A tax deduction is an amount that you can subtract from your total income before calculating the tax you owe. Deductions help to reduce your taxable income, which in turn lowers your overall tax liability. There are two main types of deductions: the standard deduction and itemized deductions. The standard deduction is a fixed amount that you can deduct from your income based on your filing status. Single or married filing separately, $12,550 married filing. Jointly, $25,100. Head of household, $18,800. Alternatively, you can choose to itemize your deductions. Itemized deductions are specific expenses that you can deduct from your income. Common itemized deductions include mortgage interest state and local taxes, charitable donations, medical expenses that exceed 7.5% of your adjusted gross income, AGI. To itemize your deductions, you must keep detailed records of your expenses throughout the year. It is generally beneficial to itemize your deductions if the total amount exceeds the standard deduction for your filing status. In addition to deductions, the U.S. tax system offers various tax credits that can help reduce your tax liability. While deductions lower your taxable income, tax credits directly reduce the amount of tax you owe, dollar for dollar. Some tax credits are even refundable, meaning that if the credit exceeds your tax liability, you can receive the excess amount as a refund. Some common tax credits include Earned Income Tax Credit, EITC. The EITC is a refundable credit designed to help low to moderate income working individuals and families. The amount of the credit depends on your income, filing status, and number of children. Child Tax Credit. The Child Tax Credit provides a credit for each qualifying child under the age of 17. For the 2021 tax year, the credit is $3,000 per child, ages 6 to 17, and $3,600 for children under 6. The credit is phased out for higher income earners. Education credits. There are two main education credits available: the American Opportunity Tax Credit, AOTC, and the Lifetime Learning Credit, LLC. The AOTC is a partially refundable credit for undergraduate education expenses, while the LLC is a non-refundable credit available for both undergraduate and graduate education. It is essential to understand the difference between refundable and non-refundable credits. A refundable credit can provide you with a refund even if you don't owe any taxes, while a non-refundable credit can only reduce your tax liability to zero. Understanding the U.S. income tax system is crucial for high school students as they prepare to enter the workforce and become responsible taxpayers. By grasping key concepts such as allowances, deductions, and credits, you can make informed decisions about your finances and ensure that you are meeting your tax obligations. Remember to fill out your Form W-4 accurately, keep detailed records of your expenses if you plan to itemize deductions, and research the tax credits available to you. By staying informed and proactive about your income taxes, you can minimize your tax liability and maximize your financial well-being. As you continue your education and begin your career, make sure to stay up to date on changes to the tax system and seek professional advice when necessary. By developing a strong foundation of knowledge about income taxes now, you will be well prepared to navigate the complexities of the U.S. tax system throughout your life